Welcome to The Explainer. You know, from an investor's point of view, some of the absolute best opportunities are hiding in plain sight. Today, we're unpacking a true outlier in the healthcare space. A company that isn't just surviving against giant competitors, it's actually winning by playing a totally different game. So here's the central puzzle we're going to tackle. In an industry just dominated by titans that grow by, swallowing each other whole, how does a much smaller player not just survive but actually thrive? How does it post growth numbers that leave the big guys in the dust? We're going to dig into Medpace, a company that really seems to be breaking all the rules. I mean, these numbers right here tell you pretty much the whole story. Medpace is just a fraction of the size of the industry leader, IQVIA. We're talking a little over $2 billion in revenue compared to 15. But then, look at the growth. Medpace is expanding at nearly 10%. That's more than triple IQVIA's rate. This isn't just outperformance, folks. This is a genuine anomaly. So the question is, how on earth are they doing it? Okay, to really get Medpace's edge, you first have to understand what a CRO is. It stands for Contract Research Organization. Look, getting a new drug approved is unbelievably complex and crazy expensive. So CROs are the expert partners that pharma and biotech companies hire to manage all those critical clinical trials. It's a huge $80 billion global industry, and it exists because the stakes are just so incredibly high. Right, so this level of performance doesn't just happen by accident. It is the direct result of two really core strategic choices. And these choices are so deep in the company's DNA that they've built this competitive moat that's just incredibly difficult for anyone else to copy. So here's pillar number one of their strategy. For over 30 years, Medpace has grown only from within, organically. Their bigger competitors do the exact opposite. They grow through these massive acquisitions. Now, that M&A strategy, it might look good on a spreadsheet, but in reality, it often leads to clashing computer systems, total cultural chaos, and service disruptions that, you guessed it, the clients feel directly. Medpace just sidesteps that entire mess. And the second pillar of their strategy? It's a laser focus on a very specific type of customer. Medpace doesn't try to be everything to everyone. Nope. They are the dedicated go-to partner for small to mid-sized biotech firms. This niche is so core to who they are, they've actually trademarked the slogan, "Trusted by Biotech." And believe me, this isn't just some marketing fluff. A staggering 81% of their revenue comes directly from these smaller, really innovative companies. Now think about that for a second. These biotechs are often betting their entire company on a single promising drug. They cannot afford any operational hiccups. They need a dedicated, high-touch partner, and that is exactly what Medpace is built from the ground up to be. And here's the beautiful part. These two strategies, they feed each other, creating this incredibly powerful, virtuous cycle. The organic-only model builds that unified culture. That culture allows them to deliver the seamless service their biotech clients desperately need. And that stellar reputation makes them the partner of choice, which in turn fuels, you guessed it, more organic growth. It's a self-reinforcing moat. It's brilliant. So that's the strategy. But for an investor, the real question is always, does it actually pay off? Does it make money? The answer is a huge, resounding yes. So let's look at how this unique approach turns into a fortress-like financial profile. First, just take a look at their balance sheet. What you'll find here is something that is almost unheard of for a company of this size. Zero. Absolutely zero debt. And no, that's not some accounting trick. They are completely debt-free, which gives them incredible flexibility and dramatically reduces risk for investors. So what do they do with all the cash they generate since they're not paying interest on debt? Well, they give it back to the shareholders. This financial discipline let them buy back nearly $1 billion of their own stock in just the first 6 months of this year. From an investor's perspective, that is one of the strongest signals management can possibly send, that they believe their own stock is a fantastic investment. This dashboard just puts it all together so clearly. Yeah, sure, Medpace is smaller, but just track the rows. Its revenue growth absolutely dwarfs its peers. And its profitability, we're looking at EBITDA margin here, which is a great proxy for cash flow. It's best in class. It's a high-growth, high-profitability engine, just in a smaller package. And here it is. This is the ultimate result for shareholders, an absolute explosion in earnings per share. The combination of rising profits and aggressively buying back their own stock has caused EPS to compound at an incredible 38% annually since 2021. I mean, wow, that is the kind of powerful growth investors dream of. But look, no investment is a sure thing. There's always a risk. And for Medpace, its greatest strength, that intense laser focus on biotech, could also be its biggest vulnerability. So let's flip the coin and look at that potential risk. You don't even have to take my word for it. The company's own founder and CEO, Dr. August Tretwindle, he defined the core risk perfectly. He said that for his biotech clients, funding difficulties are a bigger issue than drug failures. See, these small, innovative firms, they live and die by getting funding from capital markets, and those markets can be notoriously volatile. So what happens when that funding well starts to dry up? You think MedSpace would suffer, right? But here's the twist. A challenging market actually creates a flight to quality. Think about it. The biotechs with the most promising drugs know they have one shot to get it right. They can't afford to risk it on a cheaper or less reliable partner, so they double down on the best. And right now, that's MedSpace. And we are seeing this flight to quality play out in real time. At the start of the year, Medpace gave pretty cautious growth guidance, citing those funding concerns. Well, just 3 months later, they dramatically jacked that forecast way up. This isn't just a company surviving a downturn. This is a company that is actively taking market share from its weaker rivals. Which leaves us with the ultimate question for any investor looking at Medpace. Does its undeniable operational excellence and that fortress of a balance sheet make it a safe haven in a really tough market? Or does its focused strategy, that all-in bet on the volatile biotech sector, make it too exposed to a single point of failure? That, right there, is the anomaly you have to solve.